In 1933, Franklin Roosevelt declared a national bank holiday. Every bank in America shut its doors overnight. 9,000 banks had already failed. Millions of ordinary Americans walked up to their bank windows and found their life savings were simply gone. Not frozen, gone. But here is the part that never makes it into the history books. Some people lost absolutely nothing, not a single cent. Not because they were rich, not because they had inside connections, because they were using a completely different financial structure that most Americans today have never heard of. A government-backed savings system that grew 800% during the worst banking collapse in American history. It still exists in 2026, sitting in plain sight, and almost nobody is talking about it. And the reason it disappeared from every personal finance curriculum? That reason alone will change the way you look at where your money is sitting right now. The collapse nobody fully explains. Between 1930 and 1933, 9,000 American banks failed. That number gets repeated constantly. What never gets repeated is what it actually meant to the people living through it. These were not abstract institutions. These were neighborhood banks, where families kept their rent money, their grocery money, their entire financial life. When those banks closed, the deposits evaporated. There was no federal deposit insurance yet, no FDIC, no safety net of any kind. You walked in, your money was gone, and nobody was coming to make you whole. But here is where the standard narrative breaks down completely. Not all financial institutions collapsed at the same rate, not even close. While commercial banks were failing by the thousands, a different category of institution was quietly holding firm right in the same cities, serving the same neighborhoods, surviving the same storm. These were mutual savings banks. The distinction sounds dry until you understand what it actually means. A commercial bank in 1929 was owned by shareholders. Shareholders want profit. To generate profit, banks invested depositor money aggressively. Call loans to stock market speculators, speculative real estate, corporate bonds chasing maximum yield. When the stock market collapsed in October 1929, those assets vanished overnight. And your deposit, which was the bank's liability, went with them. A mutual savings bank operated under an entirely different legal structure. No shareholders, no profit motive. Legally required to serve depositors first. In states like Massachusetts, New York, and Connecticut, these institutions held conservative investments, primarily residential mortgages. Short-term, no exposure to Wall Street's gambling habits. The vast majority were still open by 1934. Meanwhile, over 40% of all commercial banks nationwide had failed during the same period. That is not a minor footnote. That is the central fact of 1929 financial survival that got buried. The people who came through it intact were not lucky. They understood that institutional structure matters infinitely more than brand recognition or branch count. They understood it before the crisis, not during it. By the time bank runs started and lines formed around the block, anyone who needed to act had already missed the window. Here is why this matters in 2026. Mutual savings banks still exist. Credit unions are structurally almost identical to those original mutual savings institutions. Member-owned. No external shareholders. Their deposits are insured through the National Credit Union Administration, the NCUA, which is a completely separate federal insurance system from the FDIC. Separate funding pool, separate regulatory framework, separate failure scenarios. If you hold $250,000 in an FDIC-insured commercial bank and $250,000 in an NCUA-insured credit union, both amounts are independently guaranteed by two entirely different federal systems. That is not doubling coverage within the same pool. That is holding assets inside two structurally distinct legal frameworks. The difference is enormous, and almost nobody explains it that way. The system that got erased. Now here is the piece that has been effectively removed from the financial conversation. The detail that banking industry lobbyists spent decades trying to bury. In 1910, Congress created the United States Postal Savings System. The concept was almost shockingly simple. Any American could walk into any post office in the country and deposit money. The United States government, not a bank, not an insurance fund with limits and conditions, the actual federal government, guaranteed every single cent. Full faith and credit, directly. No intermediary that could fail between you and your money. No counterparty risk. No institutional collapse scenario that could reach your savings. In 1929, the postal savings system held about $153 million in deposits. Modest. Mostly used by immigrants and rural workers who had long distrusted commercial banks. Then the banking system started failing. By 1934, deposits in the postal savings system had exploded to $1.2 billion. That is an increase of roughly 800% in 5 years. And the reason had nothing to do with clever marketing or competitive interest rates. The system deliberately paid only 2% annually to avoid competing directly with banks. People flooded into it because it was structurally immune to what was destroying everything around it. Not one depositor in the postal savings system lost a single cent during the worst banking collapse in American history. This is the actual 1929 strategy. Not gold coins buried in the backyard, not mattresses stuffed with cash, not the exhausting exercise of trying to identify which commercial bank was safest while they were all failing within the same system. The strategy was removing your money from the banking system entirely and placing it with the sovereign government directly. The postal savings system was abolished in 1966, not because it failed, because it worked too well. Banks had lobbied against its existence for decades. Once the post-depression reforms and federal deposit insurance stabilized the banking system, the political justification for government competition in retail deposits evaporated. Congress eliminated it, and with it went the public memory of a financial instrument that had outperformed every commercial bank in the country during the single worst financial crisis in American history. Ask yourself why that story does not appear in any personal finance book, any high school curriculum, any mainstream investment advice. The answer is not complicated. The banking industry has an obvious and direct financial incentive to ensure that no widely known historical precedent exists of government direct deposits outperforming the private banking system. So the precedent gets quietly forgotten. And people keep depositing their savings into the same institutional structure that failed 9,000 times in 1930. The exit that still exists. Here is where it gets interesting. The functional equivalent of the postal savings system is operating right now. Treasury Direct, run by the United States Department of the Treasury. Any American citizen can open an account and purchase Treasury securities directly from the federal government, bypassing banks and brokers completely. Treasury bills, Treasury notes, Treasury bonds, I-bonds, TIPS, all held in an account registered directly with the Treasury itself. When you buy a 4-week T-bill on Treasury Direct, you are lending money directly to the United States federal government. There is no bank in the transaction chain. There is no brokerage holding your assets. There is no intermediary that can fail between you and your funds. FDIC insurance exists specifically to protect depositors when the intermediary between them and their money collapses. When there is no intermediary, you do not need that insurance. The only counterparty is the federal government itself. T-bills on Treasury Direct can be set to roll automatically. A 4-week bill matures, the proceeds immediately fund another 4-week bill, maintaining near complete liquidity while keeping your money structurally outside the private banking system. No bank holiday can freeze a Treasury Direct account. No bank run can touch it. When Silicon Valley Bank collapsed in March 2023 and Signature Bank failed within 48 hours, people with direct Treasury holdings experienced nothing. The structural separation worked exactly as the historical record said it would. The mistake most people make during a banking crisis is searching for a safer bank. That reflex feels logical. It is actually the wrong frame entirely. When systemic risk is elevated, when multiple institutions are stressed simultaneously, the exercise of identifying a better bank inside a stressed banking system is like rearranging deck chairs. The 1929 strategy was not to find a better commercial bank. It was to leave the commercial banking system for something structurally different. Treasury Direct is that exit. It is the postal savings system rebuilt for the digital age. The coverage gap nobody mentions. FDIC insurance was created in 1933 specifically because of the 1929 failures. Today it covers $250,000 per depositor, per institution, per account ownership category. For most people with ordinary deposit balances, that sounds comprehensive. That is usually where the conversation ends. It should not be. In 1984, Continental Illinois, the seventh largest bank in the United States at the time, failed. The FDIC covered all deposits, not just the insured amounts, all of them, including corporate accounts far above the $250,000 limit. Why? Because regulators determined that allowing uninsured depositors to absorb losses would trigger immediate contagion at other large institutions. Large depositors at every major bank would pull funds simultaneously. The systemic cure would have been catastrophic. So the rules bent. The lesson here is not that FDIC coverage does not matter. The lesson is that in a genuine banking crisis, the rules do not follow clean, predictable lines. Sometimes coverage expands beyond the stated limit because regulators fear contagion. Sometimes, in smaller bank failures without systemic implications, it is strictly limited to the insurance cap. The coverage you believe you have and the coverage you actually receive can differ dramatically, depending on which way the political and regulatory winds are blowing in real time. Planning your financial resilience around a static reading of the FDIC rules is planning for conditions that may not exist when you actually need the protection. And there is another gap that almost never gets discussed. The Great Depression oral history archives at the Library of Congress contain hundreds of first-hand accounts from survivors. One pattern appears repeatedly. People who had physical cash during the bank closures of 1930 still could not transact normally. Merchants suspended check acceptance. Payment infrastructure froze. And the people holding large denomination bills found them nearly impossible to break when making change had become genuinely difficult in daily commerce. The people who navigated that period most smoothly were holding small denomination bills, ones, fives, tens, currency that could function as a practical transaction medium when every other payment system had seized. The modern version of this principle is simple. A 30-day supply of ordinary household cash expenses, held in mixed small denominations outside the banking system, is not a survivalist position. It is a liquidity bridge. It means that a bank holiday, a severe cyber attack on payment infrastructure, or a regional banking disruption affects you differently than it affects someone operating entirely on digital payment rails. It buys time. And in a financial crisis, time is the resource that people who are unprepared run out of first. How banks fail in slow motion. One more thing that 1929 reveals that modern financial commentary almost never addresses. Bank failures do not happen the way the phrase suggests. They do not arrive suddenly one morning out of clear sky. They develop in slow motion for months before the doors close. The indicators are visible if you know what to look for. The banks that collapsed in the first wave of 1930 shared a pattern that had been building for years before the final failure. They had been quietly reducing their reserve ratios, the cash held on hand relative to total deposits, stretching available lending capacity to maximize short-term yield. That data existed. Most depositors never thought to look at it. Today, the FDIC publishes quarterly call reports for every insured institution in the country. Capital adequacy ratios, loan delinquency trends, concentration risk, net interest margin compression. The raw material for evaluating your specific bank's health is publicly available. Most people will never read a call report. Under normal conditions, for most people, that is fine. FDIC insurance handles normal condition bank failures without depositor losses. The scenario where reading that data becomes urgently relevant is the scenario where multiple institutions are stressed simultaneously, where the insurance fund is being drawn down at an unusual rate, where regulators are making real-time priority decisions about which depositors to protect first and which to tell to wait their turn. In March 1933, the national bank holiday froze every deposit account in the United States for 8 days. People with assets outside the banking system transacted normally. People with 100% of their financial life inside bank accounts could not access a dollar. A national bank holiday is not an ancient impossibility from a different era. The conditions capable of triggering one exist right now. A sufficiently severe cyber attack on interbank payment infrastructure. Rapid regional contagion following a large institution failure. A regulatory decision to slow withdrawal velocity while emergency measures get organized. The postal savings system did not grow 800% because Americans predicted any specific scenario. It grew because completely unexpected events actually happened. and the people who had already positioned themselves discovered they were in a fundamentally different situation than the people still deciding what to do. The architecture that actually works. Here is what the complete 1929 strategy looks like translated into the actual tools available in 2026. Not theoretical, not complicated. Based directly on what the documented survivors of that period actually did. Layer 1 is your utility layer. Operating cash in an FDIC-insured account at a federally chartered commercial bank. This is for daily transactions, bill payments, direct deposits. Keep balances under the insured threshold. This money is working capital, not savings. It needs to be accessible, and it is. Layer 2 is your redundancy layer. Secondary cash reserves held at a federally insured credit union under NCUA coverage. Structurally separate from the FDIC system. Different regulatory framework. Different failure scenarios. Different insurance pool. When people talk about diversifying across banks, they usually mean different brand names operating under the same institutional structure. FDIC versus NCUA is actual structural diversification. Those are two independent federal systems, not two branches of the same tree. Layer 3 is the structural separation layer. Short-duration Treasury securities held directly on Treasury Direct, outside the banking system entirely. No insurance coverage needed because there is no intermediary to fail. This is what the postal savings system was. This is the mechanism that held firm when 9,000 commercial institutions did not. The interest rates on T-bills are competitive, particularly for what is functionally the safest cash-equivalent asset in the American financial system. Layer 4 is the continuity layer. Physical cash in mixed small denominations, 1s, 5s, 10s, held offline. 1 to 4 weeks of ordinary household expenses, not a primary saving strategy, not an investment, an insurance position against temporary disruption to digital payment infrastructure. The same logic that justifies keeping emergency water for a natural disaster applies to your ability to transact when payment systems are disrupted. This structure will not maximize your yield. That is not what it is for. There is no yield optimization happening here. T-bill rates are competitive but not spectacular. Credit union savings rates track commercial rates closely. Physical cash earns nothing. This is financial resilience architecture, not an investment portfolio. The confusion between those two purposes is precisely how people end up unprepared when conditions change. And conditions do change. The depositors who lost their savings in 1930 were not reckless. They were not foolish. They used legitimate banks. They followed the conventional wisdom of their time. They simply held claims against institutions that failed, inside a system that was failing, with no structural layer outside that system to fall back on. Your bank deposit is your asset. It is the bank's liability. When a bank cannot meet its liabilities, your asset has a problem. That is not theoretical risk. That is what hundreds of thousands of Americans experienced between 1930 and 1933. A T-bill on Treasury Direct is a claim against the United States federal government directly. Not against an intermediary, not against a holding company, not against an institution whose solvency depends on the quality of its loan portfolio. Against the sovereign government itself. That structural distinction is the entire difference between the depositors who lost everything in 1930 and the depositors who lost nothing. Why this never gets taught. The postal savings system grew 800% during the Great Depression. Not one depositor lost a single cent. The system was abolished not because it failed, but because it worked, and the banking industry spent decades lobbying for its elimination. And today, almost nobody in the mainstream personal finance industry talks about Treasury Direct as a structural alternative to bank deposits, even though it is the direct, functional successor to that system. This is not a coincidence. The banking industry has a straightforward financial interest in ensuring that the idea of holding money outside the banking system seems either impossible, impractical, or extreme. Treasury Direct makes it trivially easy. 4-week T-bills, auto roll, fully liquid, zero counterparty risk, directly with the Treasury. But if every person watching this video moved half their cash reserves to Treasury Direct tomorrow, the banking system would lose hundreds of billions in deposit base. That is why you were never taught about the postal savings system. and why you are unlikely to hear a financial advisor recommend Treasury Direct for your cash holdings. The 1929 strategy was not complicated. It required no special access, no sophisticated financial background, no wealth or connections. It required understanding one structural truth about where money is actually safe and acting on that truth before the crisis arrived. The people who had already positioned themselves when the bank run started in 1930 found that the postal savings window was still open, had been open all along, and continued operating normally while everything around it collapsed. The people deciding what to do in real time discovered that the window they needed had already closed. Deposits were frozen, withdrawals were denied, savings were gone. Not because those people were foolish, because they had not acted yet. The Roman denarius looked the same every morning until the day it did not. Your bank balance looks fine on your screen right now. The underlying structure beneath that number is worth understanding before you need to understand it. If you found this useful, hit like, subscribe, and turn on notifications so you do not miss the next one. I want to know, do you currently hold any money outside the traditional banking system? Drop your answer in the comments below.